Everyone's hyping up Trump's new tax bill like it's a game changer for real estate investors, but there's a catch, and most of you are being misled. Now, in this video, I'm going to break down what the new 100% bonus depreciation law actually says, who it actually applies to and who it doesn't, and how it could come back to haunt you later. Coming up.
The Real Estate Funding Kit is out now. Learn how to get 100% funding for all your deals without dealing with the banks. Claim your free copy at myfundingkit.com.
Trump's big, beautiful bill just passed, and amongst many benefits, it provides two big tax advantages that impact business owners and apply to some real estate investments. These tax incentives go into effect on purchases made from January 2025 through at least 2029. First, Trump's bill expanded Section 179 of the tax code, which covers things that can be deducted as business expenses. And second, it reinstated the 100% bonus depreciation, which lets you deduct the full cost of qualifying assets in year one rather than over the life of the asset. Now, I'm going to explain the benefits of these tax incentives and how they apply. But first, let's make sure you understand how these two incentives work. Let's start with Section 179. Section 179 was created to help small businesses by allowing business owners to deduct upfront tangible personal property used in their businesses. For example, equipment, tools, office furniture, computers, phones, vehicles with some limits. It even includes renovations to non-residential property like HVAC, roof, security systems, etc. A good way to think about Section 179 is I buy something, use it for my business, and write off the entire expense now instead of depreciating it over several years. For example, I build and flip residential houses, and let's say that I buy an $80,000 excavator for digging footings and foundations. Well, under Section 179, I could deduct the entire cost of $80,000 this year instead of depreciating $20,000 per year over the next 5 years. Cool little side note, it doesn't matter if you finance the purchase, it still qualifies for the deduction. So even if I finance the entire $80,000 excavator, I could write off the entire $80,000. So what doesn't qualify under Section 179? Well, it doesn't apply to land or buildings, and it doesn't apply to long-term residential rental property. Did you catch that? It doesn't apply to long-term residential rental property. However, it does apply to short-term rental properties, but only under certain qualifications, which I'll discuss later, so keep watching. It also doesn't apply to property not used more than 50% for business. Now, a few more things about Section 179. There is a total asset purchase limit in a given year, as well as a total deduction limit in a given year. The total asset purchase limit used to be $2.9 million, and now starting in 2025 under Trump's bill, that max limit went up to $4 million, and the total deduction amount used to be $1.1 million, and that went up starting in 2025 to $2.5 million. One other thing worth noting about Section 179 is it can only offset your active business income. Remember, it was designed for small businesses as a tax incentive, not a tax shelter. It can't be used to create or increase a net loss on your tax return. So for example, if your business only earns $100,000 in net active income, the most you can deduct with Section 179 is $100,000. Even if you purchased $500,000 worth of qualifying assets. But the good news is any unused deductions can be carried forward in the next year. So both Section 179 and bonus depreciation allow you to expense 100% of qualified assets in year one. So then what's the difference between bonus depreciation from Section 179? The biggest difference is Section 179 is mostly for tangible personal property, whereas bonus depreciation also applies to qualified improvements and certain real property, which we'll get into. Also, unlike Section 179, bonus depreciation is not limited by your active income. It can create a net loss. It can also offset other income if you qualify. This is why bonus depreciation is more flexible, especially for high income earners or real estate professionals. Now, pro tip here, when applying these tax deductions, use Section 179 first since it's got limits. Then if you still have deductions, use 100% bonus depreciation. Okay, now that we got that cleared up, let's talk about using Section 179 and 100% bonus depreciation for real estate. Now, there are a few applications that you may be able to take advantage of. First is short-term rentals, or STR for short. The IRS clearly states that STRs qualify only if used as a business and not as passive investments. So what does business use mean? There are two things in order to qualify as business use. First, the average guest stay must be under 7 days. The exception is if there is substantial services that are provided, such as daily cleaning, meals, and other concierge services. The second requirement is you must materially participate. That means you or your business entity must actively manage the STR. This includes setting rates, marketing, handling guests, managing bookings and turnovers, etc. If you hire a property manager and are hands-off, it will be viewed as a passive investment and it won't qualify for Section 179 or bonus depreciation. Bottom line, if you're not actively managing it as a business, it doesn't qualify. Now, there's another application for real estate that may apply, and that's if you can claim real estate professional status, or REPS for short. Now, if you can claim REPS, then long-term rentals can qualify for 100% bonus depreciation, but not Section 179. And we'll talk about those requirements in a minute. But if you qualify for REPS, then the IRS will look at your rental activity as active, not passive. That means you can use bonus depreciation to create losses that offset your W-2 income or other active income, even profits from wholesaling and flipping houses. So let's discuss the requirements to claim REPS, and then I'll give you some scenarios so that you can see how 100% bonus depreciation works. There are three main requirements for REPS. First, you must spend more than 750 hours a year in your real estate activities. That comes to about 15 hours a week on average. Second, more than half your working time must be in your rental activities. So you can't work 40 hours a week at your W-2 and then 14 hours a week on your rentals. If you work a total of 50 hours a week, 25 and a half of those hours must be in your rental business. And the third requirement is you must materially participate in the rentals. We talked about that earlier. You personally or your business must actively manage those properties. So let's say that you acquired 10 long-term rentals and you actively manage them. And let's say that you spend over 750 hours a year managing those properties. And let's say that you have no other profession. In that scenario, you could qualify for REPS and claim 100% bonus depreciation against your active income. Now, this is where this gets tricky. Let's say that in addition to managing your 10 rentals, you also flip some houses. Let's say that you're hands-on and you spend 600 hours a year on your rentals and 300 hours a year flipping houses for a total of 900 hours with no other income. Now, in that scenario, do you qualify for 100% bonus depreciation? Well, let's put it through the sniff test. Test one is, do you spend more than 750 hours in your real estate business? Well, the good news is flipping houses counts as real estate business activity, so you can count those hours. So 900 total hours meets the minimum requirement of over 750 hours, so you pass test one. Test number two is, are you spending more than 50% of your time on the rentals? So in our example, 600 of the 900 total hours working on the rentals is 67% of your time, so you pass test two. But let's say it's the other way around, and you spend 600 hours a year flipping houses and only 300 hours a year managing the rentals. Would you qualify for REPS? Well, you pass test one because your total time is 900 hours, which is more than the minimum of over 750 hours. But test two says you must spend over 50% of your time on the rentals, and 300 hours on rentals of the 900 total hours is only 33.3%. So you would fail test two, and in that scenario, you would not qualify for REPS, even though you're 100% in real estate. The key is REPS is not just about being in real estate, it's about spending the majority of your time in rental real estate, not wholesaling, flipping, development, commissions, or any other real estate activity. Okay, so assuming you qualify for REPS and you materially participate in the rentals, let's look at a scenario where you would apply the 100% bonus depreciation. Let's say that you purchased a rental property this year for $100,000 and you spend $40,000 on improvements, and let's say that the land value is $25,000. How would you apply 100% bonus depreciation this year? Well, land can't be depreciated, so you would back that out for a total basis of $115,000. So the first step is to do what's called a cost segregation study, which breaks down the short-term depreciation for things like appliances, carpet, fixtures, landscaping, windows, and so on. Now, this will look different on every project, but let's say that that comes to $28,750 that qualifies as 100% write-offs in the first year. Step 2 is to take the remaining $86,250 of your $115,000 basis, and using the traditional straight line depreciation of 27.5 years, you have an additional $3,136 that can be written off in year 1. That gives you a total of $31,886 in total write-off. But what does that mean exactly on your tax return? This is where a lot of people get confused. You don't deduct $31,886 against your tax bill, but rather the $31,886 is subtracted from your total active income. Big difference. Let's look at an example. Let's say that you're in the 12% federal tax bracket. How much would you save in taxes with this one rental applying cost segregation and 100% bonus depreciation? Well, you would take the deduction of $31,886 multiplied by the 12% tax bracket to get a savings of $3,826 on that one rental in year 1. But let's say that you're in the highest federal tax bracket of 37%. You would take the deduction of $31,886 times 37% to get a tax saving of $11,800 in year 1 on that one rental. That means if you owe $250,000 in federal taxes this year and you wanted to completely eliminate your tax bill, you would need to acquire 21 identical rentals like we just described to lower your tax bill that year to 0. Now you know how the rich use real estate to not pay taxes. Now, to wrap up this video, taking 100% bonus depreciation, if you qualify, isn't always a smart move. There are 5 reasons why it might not be a good idea to take 100% bonus depreciation. The first one is future tax bills. When you take 100% bonus depreciation, you get a nice big deduction now, but that means you'll have fewer deductions in the future. It's fun now, but the tax man's gonna come knocking later. Number 2 is it creates a tax bracket drama. Now, if you're making good money now, but expect to be in a lower tax bracket later, taking those deductions now might not be the best idea. You might want to save those breaks for when you really need them. Number 3 is it creates a tax planning headache. It can complicate your long-term tax strategy, and it might take a lot of effort and caffeine to get it all straight. Number 4 is it prevents your ability to get loans. Lenders might not love bonus depreciation because it can mess with your income when applying for loans. It's a little like bringing a snack to the party than being told that you can't eat it. And the 5th reason why taking 100% depreciation might not be a good idea is depreciation recapture, which is one of the most overlooked traps in real estate investing. No one wants to talk about recapture. When taking 100% depreciation, then when you sell that rental property, the IRS makes you pay back the tax benefit that you got from the depreciation. This is called recapture, and it's taxed at a special flat rate of 25%, not the usual capital gains rate. So let's use our previous example to illustrate how this might look. You bought a rental for $100,000. You spent $40,000 on capital improvements, and you took a $31,886 in depreciation using cost seg and bonus depreciation. Then let's say that you sell it 2 years later for $180,000. What happens with recapture? Well, let's break it down. Step 1 is to calculate your adjusted basis. You take the original basis of $140,000 less depreciation of $31,886 to get an adjusted basis of $108,000. Step 2 is to calculate the gain on the sale. So you take the sale price of $180 less the adjusted basis of $108 to get a total gain of $71,886. Step 3 is to separate the capital gain from the recapture. So the recapture is $31,886 at the 25% flat rate to get approximately $8,000. And the remaining $40,000 is taxed based on your long-term capital gains tax bracket since you held it for more than 1 year. Now, let's say that you're in the 15% bracket, you would owe $6,000 on the gain. So between the recapture and the gain, you would owe the federal government almost $14,000. That means even though you saved $3,800 in year 1 with bonus depreciation, you actually created a net negative arbitrage by selling it too quickly. What's the point? Don't take bonus depreciation unless you plan on holding that asset for a long time. Otherwise, recapture will come back to haunt you. Now, I know I covered a lot here. If any of this went over your head, go back and rewatch this. You have to understand how these tax incentives work and when it's appropriate to use them. And you can't rely on your CPA alone. You need to be able to strategize intelligently with your CPA about when and how to use these incentives based on your short-term and long-term goals. Now, having said that, if you're looking for a good tax planner and CPA, then I recommend you use who I use and my students use. I'll put a link in the description below where you can schedule a one-on-one call where my CPA will go over all of your situation and your goals and see what they recommend for you and how they can help you. Here's the bottom line. The poor are poor because they stay ignorant. The rich are rich because they learn how to legally, morally, and ethically use the tax code to their advantage. Remember, it's not how much you make, it's how much you keep that matters. I'll see you on the next video.